Hello and welcome to On the Record. I'm Shireen Bhan. The Indian hotel and hospitality industry is hoping that the recovery that it's in the midst of is going to be a resilient one, given that we are at the start of the festive season. A stock that's been a clear outperformer is Indian hotels. If I take a look at the performance just in the month of September, it's up 15%, and this year it's up 81%. So the market is clearly excited about the strength of this recovery and the resilience of this recovery. To talk more about that, joining me now is Puneet Chhatwal of Indian Hotels. Puneet, always a pleasure. Many thanks for joining us here on CNBC-TV18. So let me start by building on that. You had a great Q1. Is the recovery sustainable? How resilient is it looking at this point in time?
Well, firstly, the sector has proven its resilience despite COVID. And within the sector, we are the largest hospitality ecosystem. And I think we are very well positioned to take advantage of what I say the best is yet to come. As you mentioned, the festive season is ahead. And with the G20 planned as of December, with India getting the leadership, I do think there'll be some kind of incremental demand, which we don't have in normal years. So, yes, given our new brandscape or the reimagined brandscape, given our diversified portfolio, I think we are very well positioned to take advantage of the increase in demand.
You know, I'll talk about the G20 advantage that you spoke of in just a second, but let me address the demand issue at this point in time. Q1 occupancy of about 70%. What is the situation that you are foreseeing at this point in time?
Well, the occupancies are maintaining good levels. So typically Q2 is the weakest of the 4 quarters. But with whatever I know, and we are just 2 days to the closing of the quarter, what we are aware of in terms of top line, I think it will be as positive as we could have expected it to be, as for the entire sector. And within that, as I said, we are a large ecosystem. We have had a very good, not like-for-like growth. So we are not expecting it to be, weak in any form. I think it should be one of the better Q2s that we have witnessed as a hotel industry in the last 5-7 years.
Okay, so significantly better than the rates that you saw in Q1, or moderately better?
No, I think what I'm saying is it's holding up quite well.
Okay.
Normally it is the weakest. So if it comes as close as possible to Q1, then that's good news for the industry.
Okay. What about ARRs? Because we've also seen a growth in ARRs year on year. That holding as well, and do you believe that you will be able to do better on that metric?
Going forward, I would say the Q3 is really the decisive quarter. It's always been the best, the strongest, because of the festive season, followed by the wedding season, followed by Christmas, New Year. Everything happens for the best in our industry in Q3. So I think the rates and the increase in rates, we will have to wait till November to see if that's moving in that direction. My personal opinion is it will. We have room to grow. We have room to grow since not post-COVID, but for the last 10 years. And the kind of quality of hotels we have, the kind of service we provide, the kind of offerings we have the ability to charge, but we have not really seen that as much as we are seeing it now. So I think all the brands, the sector per se is demonstrating the ability to charge higher rates.
So how much pricing power can you exercise at this point in time, given the demand environment?
I definitely feel that on the business side, leisure is strong. It's, for our portfolio, it performed at 15,000 rupees, let's say. And business was at 10 to 12, and I think there is no reason why that should not hit 15 in the months to come.
Okay, let's talk about international travelers, because the restrictions have been lifted. But as we heard from the secretary, we were speaking with him earlier today, he said it's only been a trickle so far. Do you worry about the fact that given the global environment, the possibility of a recession, that trickle is likely to continue to be the trend and not turn into the deluge that industry was hoping for?
Well, Shireen, for the lack of better sentence, which I've used with you on your channel several times, I think this too shall pass. So, of course, shutting down is an easier decision. When you reopen, it takes time to kickstart any business, any industry, any sector. So I think with the October to March is typically when you get the international tourists, so it may not happen as much in October, but I'm very optimistic that as of November or at the latest as of January, February next year, that international travels will start coming back on the leisure side. On the business side, it's already coming. I mean, we have had a lot of global CEOs already visiting India in September. So that's been good news. And recently there was a JP Morgan Congress also in Delhi. So I do think that's business travel has started. The flights are full. The airfares are, very high. But of course, the number of flights is less. So at some point, the demand and supply will balance out, and we will get to see more and more people coming in.
Let's talk about supply. You talked about G20. What we are seeing at this point in time is that the hotel industry has the appetite to grow, but not quite the financing ability to be able to grow and deliver on the kind of supply requirements. Yours is a different story in comparison to many others at this point in time. But this supply-demand mismatch, how do you see it panning out? And is that invariably going to mean good news for at least branded players like yourself if there isn't additional supply that comes into the market?
Well, I would like to state it differently. As long as demand continues to outpace supply, your pricing power will be strong. If supply does it the other way around, it outpaces demand, then the rates are always under pressure. So at the moment, given what has happened in the COVID times, I definitely feel demand will outpace supply in the major metros. But there is a strong need, given all the schemes the government has put in for development of infrastructure, with the Project Udan, with the new airports, with the Prime Minister Gati Shakti scheme. So I think all these would require a lot of infrastructure development, which is also the focus on the last budget that we had. And the indirect beneficiary of the infrastructure investment is obviously hospitality. And a lot of hotels need to be built in tier 2, tier 3 cities. And I think it's a good opportunity for the sector. Should we get the amendment in the infrastructure status, which we have been lobbying for, requesting for, asking for a few years now. For some reasons, it's limited to a population of 1 million. Should that get changed and amended, because it's based on a 2011 consensus, I think it gives you cheaper loans and a longer moratorium period. And at the same time, if the sector gets the industry status in the different states, some states have given it, but if others follow, I think that will improve the investment appetite in the hotel sector, and which will help in phenomenal job creation.
We'll talk about job creation in just a second, and the dichotomy that we are seeing in with respect to human capital for the hospitality sector in a second. But I just want to address the pipeline issue with you specifically. FY23, a pipeline of about 8,000 plus rooms is what I understand you're looking at. But given the G20 advantage, could this number look very different?
Well, G20 is around the corner, and hotels cannot get built overnight. Sure. So I think what could be different is maybe getting some mobile accommodation or tented accommodation. Luxury tents is possible to do that in a shorter period of time. But our pipeline and managing the pipeline is a very strong focus for the management. And our 8,000 pipeline can only increase, but it will not, become less. And we've been opening a hotel a month. This year we've already opened 6. But based on all the knowledge we have today, we should open 2 hotels a month in the second half of the year, which means another 12, which takes the total to 18, which means 1.5 hotels a month. And I think that's a very good pace given where we are coming from. As a legacy company with over 100-year history, I think this is not the way we have grown. And a lot of this growth is coming in different segments. And at the same time, if we add homestay business to it, we just signed our 100th homestay under the Ama brand. I think our growth and our pipeline is very robust and very good because most of it is driven by fee-based business.
I wanted to address the issue of consolidation, especially within the branded space, as well as the attempt to bring unbranded into the branded space. Do you have the appetite to play consolidator in this market?
Well, to some extent, we have been playing
Yeah.
because a lot of our pipeline is not new build. So currently, 30% of our pipeline is based either out of existing hotels, which are getting remodeled into one of our brands, or they are brownfield sites where, the construction was 60, 70% finished. But going forward, as distribution becomes more and more sophisticated and sales and marketing and digitization, I think some of the consolidation will be a consequence of that. And with our brandscape, we are, as I said, very well positioned from Ginger to Vivanta to, Selections having a collection of hotels. But we'll try to keep Taj as pure, as iconic as it has been for the last 120 years. So that part, will not just pick up a hotel just for the sake of, increasing the pipeline. So Taj remains the backbone, the most iconic brand India has produced. So that definitely no, but consolidation at a different level, at a different segment, yes, we are well positioned to take advantage.
You talked about the management fee, and I want to understand from you what the trajectory as far as new initiatives and new revenue streams are concerned. We've already seen that grow. What is the expectation on that front?
Well, we expect to double our management fee income from a pre-COVID level in the next 2-3 years, which is very good because management contracts are considered as the sweet spot of the industry. And that is the change in business model that has been driving our margins. So when there is an upswing in the cycle, you benefit from both. You have the operating leverage in your owned and leased portfolio because things are looking good and things are going up. At the same time, you have the benefit of management fee income coming in, which drives a higher margin because you don't own the P&L. So that is one of the reasons we have given the guidance under Ahvaan 2025 that we would want to aim for 33% EBITDA margin.
Yeah.
That's an aggressive number, knowing that between 2010 to 17, our average EBITDA margin for the year was like 13-14%.
Yeah. So that's exactly my point. To go from 10 to 13%, which was the decadal average, now to the guidance of 33%, what are you doing differently to be able to deliver on this performance, to be able to deliver on this growth?
The strong growth is one. So when we went for Aspiration 2022, which we stopped because of the COVID, we gave the guidance of going to 25%. By the time we were in COVID, 19-20, we had hit 24.8%. So almost got to 25% EBITDA margin. And now post-COVID, with all the properties that we have added to our pipeline, with all the openings that are coming in, with all the optimization of costs, with the increased revenue coming in now, the renovations, the upgradations of a lot of hotels to Taj level, almost 20 of those. That includes the Fish Cove, the Holiday Village, the Fort Aguada, the Taj Mahal Lucknow. They were all upgraded, renovated. Number 3, our focus on Ginger, which is a high margin business. So we classify the reimagined Ginger, the Ama and Cumin as our new businesses, including the private membership club reimagination of the Chambers. And these are very high margin businesses. All of them deliver north of 35%. Chambers, the membership fees could deliver up to 85% margin. Our QSR and Cumin home delivery has always done north of 40% margin. Ama, our homestay, does 60% margin. So even though they are small, as a percentage, they take the average up. And that has been a part of a business decision we took and the strategy that we communicated and executed during COVID times exactly in the same way as if we were doing it in a pre-COVID time.
We'll take a break here on the record and continue our conversation with Puneet Chhatwal of Indian Hotels when we return. Welcome back. You're watching On the Record. We're in conversation with Puneet Chhatwal of Indian Hotels. Speaking of expansion and speaking about future growth opportunities, on the disinvestment front, of course, the nearby Ashok Hotel has been put up by the government, and I know that you're one of the contenders for that. How confident do you feel about it?
That's news to me. I did not know that we were contending.
Are you not a contender?
I don't know. We have a little shareholding in ITDC together with LIC. And Ashok Hotel is a very special hotel. It was built under special circumstances, and something you didn't know, I'll tell you today. I spent my initial years of career in that hotel, and I know every corridor of that hotel.
So it would make sense then, wouldn't it?
But it's not, it's not my private company. It's not my own company. So I think we will take whatever decision is there, which is in the best interest of the company. There are very few people, or very few brands, better said, who have the capability to run an institution like the Ashok. And definitely Taj qualifies amongst one of those very few players that are there. It's a very, very iconic asset. And I would say it's maybe the best located asset in this part of the town. And but it's a lot of work in repositioning, redeveloping, and reimagining the Ashok. It's going to be time and capital intensive.
Are you up for the challenge?
Well, not alone, but should we get help from other group companies, happy to take on any challenge because of the change in our business model. We are not into developing and owning assets of that magnitude because there is a lot of space for serviced apartments, and so there is a lot of real estate play in. That's not our business model. Our business model is to run hotels. We will be happy to run the Ashok, but not to do everything else that comes with it.
Speaking about running hotels, and I want to talk about international expansion plans as well. I was talking to one of your peers, and they're now looking at least within the region or close to the region at being able to run properties. You've already got international businesses in play at this point in time. Is that something that you are going to now, with COVID being sort of behind us, aggressively restart to look at?
Not aggressively, but selectively. So we have always done that. Even in the last 2 years, we have opened 2 more Taj properties in Dubai, taking the total to 3. A 4th one will be opening in another 2 years from now. So 4 Taj branded hotels in Dubai. 1 is under construction in the holy city of Makkah. We would look at one or the other strategic European destination. And also once we have better understanding of where our airlines are going to fly to, where we have that kind of competitive advantage, we will look at those, but definitely not to own any assets. We will not buy assets. We will manage third-party assets or enter into an operating lease with an institutional investor, which is a very common model in Europe. And we are very proud to have the Buckingham Gate, the St. James Court in London. The same is with the Pier in New York. And I also feel some nice properties like San Francisco and Cape Town will do us a lot of good going forward. So idea is to selectively expand without losing, without owning and without losing focus on our home market, which is the Indian subcontinent. We want to take our portfolio to a kind of size that no one would have thought is possible in such a short term. So if we are today a total portfolio of 240 hotels with 65 hotels in pipeline, the guidance we have given is 300 plus, of which definitely no more than 30 will be outside of India.
Okay.
So 290 as a portfolio will be India based, and hopefully next year, sometime mid of next year, we will be opening our 200th hotel in operation. So we are at 180 as we speak. So I think all in all, good news for us.
Well, speaking about group companies, and you just alluded to the fact that you will decide on your selective international expansion plan basis the airlines expansion plan as well. Now you, of course, have Air India within the group's fold. What kind of synergies are we already seeing, and what more is to follow?
Well, with both Air India and Vistara, I think we will see a lot of synergies going forward. It's not that we were not in business with either of them.
Sure.
Vistara, the flight kitchen was almost from every station where we have a flight kitchen business was done by us. With Air India, it was less because of the government tender procedure with the cheapest one getting the tender. But I think a lot of focus will be in Air India on repositioning it as a quality and a leader in quality. And I think with that, we will have good opportunities in serving hospitality in the air and also serving hospitality on the ground for Air India staff and key customers of Air India. And definitely, we will look at synergizing with Air India as much as possible.
Let's address the human capital issue. And as we were just discussing, there has been a significant reduction in the number of people that this industry is employing on account of the pandemic. And the view is that it's not going to go back to the kind of human capital requirements pre-pandemic. There is rationalization and perhaps right staffing, you could call it that. Was the industry overstaffed? Where do you see things in terms of hiring going forward?
Well, I would not say the industry was overstaffed, but the upper upscale and luxury was definitely overstaffed.
Were you overstaffed?
I would say yes, for sure. So we were able to reduce our corporate overhead by 27%, or almost, let's say, 30% adjusted for inflation. But we did not lay off any people, but we were able to redeploy them because of our growth, because of growth within the group companies. As an example, we were able to send some of our people and give them a better opportunity with Tata Digital, because we joined with Tata Digital to be on the Tata New platform. So our people go and do a good job for our brands and the loyalty program in another group company. Similarly, some got good opportunities with, let's say, Tata Trust or Tata Consumer. So we have not only been able to reduce that cost and rationalize it, but also the size of our portfolio has grown. So we have a huge amount of efficiency that has been achieved without, any kind of short-term measures of cutting into the bone, I would say. So I think people got an opportunity to grow. We were able to rationalize costs. We became more efficient. Our margins grew, and there has been no compromise on service. And Taj became the world's strongest brand for second year in a row, and India's strongest brand for a third year in the row. 1 year it was number 2, but as per brand finance. So there is that is the proof, whether you are on the right track or not.
Let me end by asking you, Puneet, you've delivered a decadal high performance at this point in time. What kind of pressure is that putting on you? And what is the single biggest risk that you see to the projections that you've put?
Well, I have always said the best is yet to come. So there is no pressure, because I've said it myself. However, there are risks around us these days. When we open CNBC-18 in the morning, then we hear the Brent went up, the Brent went down, then we have the dollar went up, the dollar index went down. There is something happening in, the RRR, as I think the Morgan Stanley people said on your channel, the recession, Russia, and the rates hikes. So there are things which are out of your control. So whatever is out of my control, that does not bother. The job of the management is to mitigate through all possible crises. But these are things like COVID. We could not have done anything about it. What we did and how we conducted ourselves, that was under our control. And I think on that front we did well. But I do believe the best definitely is yet to come, and Q3 will be a good judge of that.
Well, we wish you the very best of luck. Always a pleasure. Thanks very much for joining us here on The Record. Appreciate your time. And we hope that the festive season delivers on the kind of hope that you have set out for yourself and for the group. Appreciate your time. That is it on this edition of On The Record. We are going to take a break, but there's a lot more coming up for you on CNBC TV 18. From all of us here for now, goodbye. Many thanks for watching.